Okay, so today we're going to talk about a hedging strategy to help you get out of a bad position. Let's say you're playing in Forex. This is the Australian New Zealand dollar pair. Your technical analysis up to this point tells you it's going up. You buy in, you buy the pair, it goes up, and then all of a sudden plummets down. Now this could happen for any number of reasons. Remember, it doesn't matter how good of a technical analyst you are, how good you are with charts, any of that. It doesn't matter because it's not affected, or you can't predict real-time world events that affect the markets. This could have been a Trump tweet. This could have been a terrorist attack. Any real-world event can affect these things in real time, and that's something that's not going to show up prior in the chart itself for you to analyze and detect. So that's a weakness in technical analysis. A lot of guys are using robots and trading automatically, some things like that going on, but this is a position that you can find yourself in. It really was looking strong. It was going up. It was going up. Some world event happened here and caused it to go back down. So as it crashed down, now our position is in trouble. And this particular pair, it just kept going south, right? It just kept going lower and lower and lower. It's not coming back. Another pair happened the same day is the euro pound, and there's quite a few pairs that did this that same day. This is just this week. This is another one, and just kept going down and down and down and down. Now, if you let this go too far, it's going to eat up your equity, and you're not going to have any equity left in your account. So this strategy I'm going to show you will help you get out of these terrible trades, or these trades that went terrible, went the wrong way, and are really going south and eating up your equity. They're jeopardizing your account. So the biggest question I get is, how do you know when to hedge? When you're worried about a trade that keeps going in the wrong direction, and when your position starts putting your account equity in jeopardy, then you know. So if it's going in the wrong direction, it's hitting way, wham, you see this big spike down, you can, get kind of concerned at that point. Maybe it's not going to come back real quick. It depends on how much equity you have in your account, how much time you have to really decide what happened and whether to hedge or not. As you will see, it's possible not only to save your account in equity, but to actually get out of these trades with a profit. And I know some people are looking like, I don't know how you're getting out of that one. It just went down. It's going to keep going down, keep eating at your equity. Well, I'm going to show you how to do this. I'm going to show you how to get out of these bad trades or trades that went bad, and how to actually make money from them most of the time. So first you have to determine what your line in the sand is as to when you're going to start hedging. I get asked all the time, when is it too late to start hedging? Well, the simple answer is it's never too late to start hedging a position. If your account equity is taken over by debt of that position, then the broker will close that position at a loss, and for the most part it's going to bankrupt your account. At that point, there's obviously no position left to take the opposite position on or hedge. So as long as you have a position open and enough equity to or enough left on margin at least to open another side or another trade or another position, then it's not too late. So the first thing we do is open a position opposite the currency pair that is going in the wrong direction. We will open it with a lot size that is bigger than the current open position. So if we bought this pair and now it's going down, let's say we bought this pair at lot size of 1, right? Maybe you bought in here and you thought it was going to go up, or you bought here and thought it was going to go up, but it kept going down, right? Let's say we bought in here at a lot size of 1, climbed up a little bit, we're looking good, and then it plummets down. Well, and you thought it's going to come back up, and then whoom, and then wham. Okay, so we're in it at a lot size of 1. We're hemorrhaging money. It's not coming back. It just keeps going lower and lower and lower. Our equity is getting lower and lower, and we need to get out of this thing somehow before it wrecks our entire account. So what we're going to do is take the opposite position. So in this particular case, we bought the pair, the euro pound pair. Now we need to sell the euro pound pair. And we bought it at one lot size of 1. We're going to sell it at a lot size of 2. Okay? So what that's going to do is give us the other side. It's going to help save our account and save our equity. So as this continues to go down, our equity will actually go up, because as it goes down, our sell side position is going up twice as fast in value as our buy position is going down, right? So here's kind of what this looks like. You can see from this one here, it's a $15,000 account, 4,600 right here in the negative. Little bit of margin. There's 1,500 margin, so we got something to work with. Equities, got some equity to work with in there. So when you look at this account, it's going to show you where we need to go. So at this point, there's the pound yen. We saw the other one, the Australian, New Zealand. A bunch of these did that same thing this week. There's a Canadian. These big ones are going sideways, going the wrong way. This particular one, the pound yen, this is bought at 1.15 lot size. So we would double that, or it was sold at that lot size. To hedge this position, we would double it on a buy. So it'd be 2.3. Lot size is 2.3, and we'd buy that pair at 2.3. Now what we're looking for is, as it continues to move in the wrong direction for our original trade, it's going to be helping us out, because we're going to get back some equity and we're going to be able to get out of this thing. So when this is going to reach about $5,000 in negative, about the same time our other buy side is going to reach 5,000 in equity, 5,000 in the blue. So this will be minus 5,000, the other one will be plus 5,000, somewhere in there. So once they're almost even, these two numbers, your negative amount and your positive amount, once those things are almost even, you can start getting out of this position, right? So what we do is we sell off a partial of each one. So in this case, the number is big enough. You're dealing with $500 or $5,000 negative, $5,000 positive. I would start at least 500. Start knocking it out at $500 a shot. So what you do is, this is using MetaTrader. MetaTrader, you just hold down, click it, and hit close. Now when it goes to close, we're going to change the lot size. Instead of selling the whole 1.15, we're going to sell a little bit less. So what I'm going to do is go down, I'm going to keep my eye on the dollar amount and not at what we actually, how much of it we're selling. So let's say we're going to sell $500 of it. I would just crank this down, the lot size down in the close tab until it hit $500. And bang, I would hit close and I would take that $500 loss. I would then immediately go to the buy side and do the same thing, and I would take 500 profit out of the buy side. So now we just limited our position and limited our exposure, and it cost us absolutely nothing. As the trade keeps going down and keeps going sideways, by sideways I mean keeps going the wrong way than we originally got into it at, right? if it keeps going up, this is our original position. If this pair keeps going up, we're going to keep gaining equity and we're going to keep gaining ground on this thing. So every $500 that went up, I would take 500 out of here. I would take 500 out of the buy side, keeping our balance sheet even, right? We haven't taken a loss. Actually, we lost 500 and we gained 500. We lost 500, we gained 500. And we keep doing that back and forth. And the whole time, this number is getting smaller and smaller and smaller. So instead of a minus 3,000 or minus 5,000 when we start this thing and 1.15 lot size, it's going to get down within a few turns to, you know, a 0.5 or a 0.3 or a 0.2 lot size, and then it's really not going to affect our account, right? 0.2, and if we have 0.2 lot size and it's down, you know, $200-300, no big deal, right? $200-300 is not going to put this $15,000 account in jeopardy. 5,000 will, especially compared with the other ones, or added up with the other ones that are going sideways as well. So here's kind of what this looks like as we go and look at this further. So this is what this is going to look like. These are actual sales, and you see as I started closing out different trades, I hedged each of the pairs that were going sideways. I hedged each of them, and then I would sell them off. I'd take a minus 500, and then the pound yen, then I'd take a plus 700, right? And you can see I just kept the euro pound, euro pound, euro pound is that other chart we were looking at. Pound yen, you can see all these different ones. And at the end of the day, right, this is a day chart. At the end of the day, cleared out all these trades, all these positions, and ended up with $330 in profit. So I took, what is $5,000 roughly in the minus, which is really putting the squeeze on this account, and hedged out of it, and actually hedged out and ended up with a $330 profit for the day. So that's how you do it. Basic terms, we're going to take the opposite position of the one that went wrong. We're going to double down on that new position. We're then going to wait till it starts getting in the blue and we get some good money in there. And as it keeps moving, we're going to keep selling off both of them. And if you do this right, most of the time you're going to end up actually making a profit instead of going completely bankrupt. So if you have any questions, feel free to hit me up. That's how we hedge out of a position or a trade that went the wrong way.